Something just fractured in gold and silver markets. CME-Shanghai exposed. They're telling you it's a normal correction. Meanwhile, two exchanges on opposite sides of the planet just did something they've never done in 20 years. On the exact same day, America and China, they argue about trade, they fight over technology, they can't agree on anything except this. Precious metals margin policy. Perfect coordination. When was the last time that happened? And the question isn't why prices dropped. The question is, what's missing from the vaults that nobody wants to acknowledge? Welcome to your John A.G. Now, if you've been around long enough to remember when a handshake meant something, when people kept their word without lawyers, then you know that when old rivals suddenly start agreeing, something serious is happening behind closed doors. Do me a favor. Hit that subscribe button, not because I'm asking, but because the next move might happen while you're not watching. And drop a comment. Tell me where you're watching from right now. New York, London, Singapore, Mumbai. Because what's happening in clearinghouses today will show up in your business tomorrow. Let's begin. On January 14th, 2025, something unusual happened in the global financial system. The Chicago Mercantile Exchange raised margin requirements on gold and silver futures contracts by 18%. 3 hours later, the Shanghai Gold Exchange did exactly the same thing. Same day, same percentage, same metals. For anyone watching clearinghouse operations, this was impossible to ignore. These two exchanges don't coordinate. They compete. They operate in different time zones, under different regulatory frameworks, serving different client bases. CME serves Western institutional traders. Shanghai serves Eastern physical buyers and Chinese state entities. They have spent the last decade moving in opposite directions on almost every policy decision. When CME tightened dollar liquidity requirements in 2022, Shanghai loosened yuan financing terms. When Shanghai restricted foreign access to certain contracts in 2023, CME expanded international trading hours. This is how commodity exchanges normally behave. They fight for market share. They differentiate their products. They do not wake up on the same morning and implement identical policy changes. But on January 14th, they did. And that coordination tells a story that price charts cannot. Margin requirements exist for one reason: risk management. When an exchange raises margins, it is telling the market something specific. The volatility models are showing stress. The clearinghouse needs more collateral to guarantee settlement. But here is what most analysts missed. Both exchanges raised margins not because prices were rising too fast. Gold had been consolidating for 3 weeks. Silver was trading in a tight range. Volatility was actually declining. So why did two clearinghouses on opposite sides of the world suddenly demand more collateral when markets were calm? The answer is not in the price charts. It is in the settlement data. And what that data reveals is a problem that the commodity finance system was never designed to handle. Every futures market in the world operates on one core assumption: cash settlement. When a trader buys a gold futures contract, they are not actually buying gold. They are buying a financial instrument that references the price of gold. When the contract expires, the vast majority of traders simply settle in cash. They take their profit or loss in dollars or yuan, and they move on. The entire derivatives system is built around this behavior. CME's risk models assume that only 2 to 4% of contracts will ever result in physical delivery. Shanghai's models assume roughly the same thing: the clearinghouse infrastructure, the warehouse capacity, the financing arrangements, the insurance policies. All of it is designed for that ratio. 2 to 4% requesting physical metal, 96 to 98% settling in cash. This is how the system has functioned for decades. But in late 2024, something changed. Delivery requests started climbing. Not from retail investors trying to get coins shipped to their homes. That happens every year, and clearinghouses know how to handle it. This was different. Institutional buyers, sovereign wealth funds, central bank proxies, family offices managing generational wealth. They started demanding physical metal instead of cash settlement. By December 2024, delivery requests had reached levels not seen since the 1980s. And for anyone who remembers what happened in the silver market back then, that comparison should be concerning. In 1980, the Hunt brothers attempted to corner the silver market by demanding physical delivery on massive contract positions. The exchanges changed the rules mid-game. They implemented position limits. They restricted new buying. They forced cash settlement. The market collapsed. The Hunt brothers went bankrupt. But the system survived because the exchanges could still deliver the physical metal that was actually demanded. 45 years later, the demand pattern is similar, but the capacity to deliver is not. And this is where the January 14th coordination becomes significant. When CME and Shanghai raised margins on the same day, they were not reacting to price volatility. They were reacting to settlement risk. They were acknowledging, through policy action, that the physical delivery demand was exceeding their operational capacity to fulfill it. And when clearinghouses start coordinating across geopolitical boundaries, when rivals start moving in perfect synchronization, it means the risk they are managing is no longer a market risk. It is a systemic risk. The kind of risk that does not respect borders, time zones, or political differences. The kind of risk that forces coordination even between governments that publicly oppose each other on virtually everything else. So the question is not why gold and silver prices dropped after the margin increase. The question is what happens next when institutional buyers keep demanding physical delivery and the clearinghouses run out of metal to give them. There's a lawyer in New York who specializes in something most people have never heard of: exchange default procedures. He does not work on corporate bankruptcies or mortgage foreclosures. He works on the legal frameworks that govern what happens when commodity clearinghouses fail to settle contracts. For 15 years, he has studied the rulebooks, the default waterfalls, the guarantee fund mechanisms, the member liability chains, and in a private conversation last month, he said something that should make every business owner pause. The system has a plan for member failures. It has no plan for settlement impossibility. Let that sink in for a moment. If JP Morgan went bankrupt tomorrow, the clearinghouse knows exactly what to do. Seize the margin deposits. Tap the guarantee fund, spread the losses across other members. It would be painful, but the system would survive. But if 100 institutional buyers show up demanding physical gold, and the metal simply does not exist in the vault, there is no legal procedure for that. Because the system was never designed for that scenario. And this is not a theoretical problem anymore. It is happening right now. The evidence is sitting in publicly available data that almost nobody is reading. COMEX warehouse reports, Shanghai Gold Exchange withdrawal statistics, London Bullion Market Association clearing volumes. The numbers tell a story that the financial media is not covering. In December 2024, COMEX eligible gold inventory dropped to 8.2 million ounces. That sounds like a lot of gold. Until someone does the math. There are currently 51 million ounces of gold in open futures contracts. On COMEX, that means for every ounce of actual gold sitting in the warehouse, there are 6 ounces of paper claims against it, 6-1. And this ratio assumes that all the gold in the warehouse is actually available for delivery, but it is not. Much of it is already pledged as collateral for other transactions. Some of it is leased out to bullion banks, some of it is encumbered by prior claims. The actual deliverable supply is far smaller than the reported inventory. This is the reality that clearing houses are now confronting. And it gets worse, because the banking system that used to provide liquidity to these markets has quietly stepped back. In 2023, the Bank for International Settlements published a report that went mostly unnoticed. Buried in their annual economic review was a single data point. Banks now hold 40% less commodity financing capacity than they did before Basel III reforms were implemented. 40%. That is not a small adjustment. That is a structural collapse in the financial infrastructure supporting physical commodity markets. Basel III regulations forced banks to hold more capital against commodity positions. The net stable funding ratio made it expensive to finance physical inventory. The supplementary leverage ratio penalized balance sheet usage, even for low-risk commodity holdings. So the banks did what banks always do when regulations make something unprofitable. They stopped doing it. JP Morgan reduced its commodity trading desk. Goldman Sachs restructured its physical metals operations. Deutsche Bank exited most commodity financing entirely. The result is a global commodity market with far less banking support than it had a decade ago. And this would be manageable if demand for physical delivery remained at historical levels, but it has not. Because while Western banks were stepping back from commodity finance, Eastern central banks were stepping forward as buyers. In 2022, central banks purchased 1,136 tons of gold. In 2023, they purchased 1,037 tons. In 2024, preliminary data suggests purchases exceeded 1,100 tons again. 3 consecutive years of purchases above 1,000 tons annually. That has not happened since the 1970s. And the buying is coming from a very specific group of countries: China, Russia, Poland, Singapore, India, Turkey, Uzbekistan, nations that are either outside the Western financial system or actively trying to reduce their dependence on it. They are not buying gold as an investment. They are buying gold as infrastructure. Because gold is the one asset that does not depend on another country's legal system to have value. It does not require swift access. It does not require correspondent banking relationships. It cannot be frozen by sanctions or seized by foreign courts. In a world where the United States has weaponized the dollar through financial sanctions, gold is the only truly neutral reserve asset. And central banks are accumulating it at a pace that the derivative markets cannot support. Here is why this matters for the clearinghouse problem. When central banks buy gold, they do not buy futures contracts. They buy physical metal, they take delivery, they store it in their own vaults or in trusted depositories outside Western jurisdiction. That gold leaves the system. It does not get leased back to bullion banks. It does not sit in COMEX warehouses available for delivery against futures contracts. It disappears into central bank reserves where it may never return to the market. Every ton that a central bank purchases is one less ton available to settle derivative contracts. And the banks that used to provide the financing to bridge this gap are no longer willing or able to do so. This is the infrastructure breakdown, not a market crash, not a manipulation scheme, a structural mismatch between paper claims and physical availability, between derivative obligations and settlement capacity, between what the system promised and what the system can actually deliver. And when that mismatch becomes too large, like when institutional buyers demand delivery and clearinghouses cannot fulfill, the entire architecture fractures. January 14th was not the beginning of this problem. It was the first public acknowledgement that the problem exists. There is a building in Basel, Switzerland, that most people have never heard of, the Bank for International Settlements. It sits on Zentralbahnplatz, a quiet square near the train station. No armed guards outside, no protesters, no television cameras, just a cylindrical tower where the world's central bankers meet every 2 months. And inside that building, over the last 3 years, something has shifted. The conversations have changed. Not in the public speeches or the official press releases. Those still talk about inflation targets and interest rate policy and financial stability. But in the private meetings, in the closed-door sessions where governors speak freely, a different topic has emerged: settlement independence. The ability to conduct international trade without depending on systems that can be shut off by political decisions made in Washington or Brussels. This is not a conspiracy theory. This is documented policy. And it is reshaping the entire foundation of how commodities are traded globally. In March 2024, a professor of international economics at Peking University published a paper that received almost no attention in Western media. The paper analyzed 247 bilateral trade agreements signed between 2020 and 2024. And it found something remarkable. 73% of agreements signed by BRICS nations in 2023 included provisions for non-dollar settlement, 73%. Compare that to 2019, when only 12% of agreements included such provisions. This is not gradual evolution. This is architectural redesign happening in real time. And gold sits at the center of this redesign. Because while dollars can be frozen and euros can be sanctioned, physical gold cannot. A central bank holding gold in its own vault has an asset that does not depend on another country's permission to use. And this is why the buying patterns over the last 3 years are so significant. China has not officially reported its gold reserves since 2019. But independent analysis of import data, mining production, and refinery output suggests China has added somewhere between 5,500 and 2,300 tons to its reserves since then. Russia, despite being under the most severe Western sanctions in modern history, continues to purchase gold from its domestic mining production. Every ounce of gold mined in Russia goes directly into central bank reserves. Poland has increased its gold holdings by 150 tons since 2021. Singapore has quietly become one of the largest gold storage hubs in Asia. India's central bank added 150 tons in the last 18 months alone. These are not investment decisions, these are infrastructure decisions. And the infrastructure they are building is an alternative settlement system. In October 2024, a new payment platform went live, M-Bridge. It is a multi-central bank digital currency platform that allows direct cross-border payments without using SWIFT or correspondent banks. The founding participants are China, Thailand, Hong Kong, the United Arab Emirates, and Saudi Arabia. The platform is built on distributed ledger technology. It settles transactions in seconds instead of days. It eliminates the need for dollar intermediation. And here is what almost nobody noticed in the technical documentation. The platform includes a module for commodity-backed settlement. It is designed to allow central bank digital currencies to be exchanged directly for trade in physical commodities, including gold. This is not theoretical. The technical infrastructure exists right now, and it is being tested with real transactions. In November 2024, a Chinese oil importer paid a UAE supplier using M-Bridge. The transaction settled in yuan and dirham. No dollars involved, no SWIFT message, no correspondent bank in New York reviewing the payment. Direct settlement in under 4 minutes. For 70 years, the global commodity system has operated on one fundamental architecture. Commodities are priced in dollars. Payments are cleared through New York banks. SWIFT messaging routes the transactions. The Federal Reserve and the U.S. Treasury have visibility and control over the entire system. That architecture is now being duplicated outside of Western control. And physical gold is the anchor asset making it possible. Because digital currencies are new, blockchain settlement is unproven at scale. Central banks are cautious about depending entirely on technology they do not fully control. But gold is 5,000 years old. Gold is trusted. Gold works when the power goes out, when the internet fails, when sanctions are imposed, when political relationships collapse. And this is why central banks are accumulating it at unprecedented rates. They are building a parallel settlement system, and gold is the foundation. Now, here is where this connects back to the clearinghouse problem. Every ton of gold that moves into central bank reserves is one less ton available in the commercial market. Every transaction settled in yuan gold or dirham gold instead of dollars is one less transaction flowing through Western clearinghouses. Every bilateral agreement that allows commodity trade outside the dollar system is one less reason to hold dollars as reserves. This is not happening overnight, but it is happening faster than most analysts realize. And the derivative markets are not priced for this transition. COMEX futures assume that gold will continue to trade primarily as a financial asset, that most contracts will settle in cash, that physical delivery will remain a minority use case. But what happens when half the world decides that gold is not a financial asset at all, but rather a settlement asset? What happens when oil exporters start preferring gold-backed digital currency over dollars? What happens when trade between Asia, the Middle East, Africa, and South America increasingly bypasses Western financial infrastructure entirely? The answer is already visible in the data. Basis spreads between paper gold and physical gold have widened to levels not seen since 2008. In normal markets, the difference between a futures contract and physical metal is $2 to $5 per ounce. Today, in certain markets, that spread has exceeded $50. $50. That is not a transaction cost. That is a system telling the market that paper and physical are no longer the same thing, that the promise to deliver and the ability to deliver have diverged. And when promises and reality diverge, someone gets trapped in the middle. Usually it is the people who believe the promises, the traders who thought futures contracts were as good as metal, the institutions that assumed settlement would always be possible, the businesses that built supply chains around commodity derivatives without understanding the infrastructure underneath. January 14th was the day two clearinghouses admitted, through policy action, that the infrastructure is stressed. And the reason it is stressed is not temporary. It is structural, because the world's monetary architecture is being rebuilt, and the old system is running out of the one asset the new system needs most, physical gold. There's a screen that very few people watch. It sits on the Chicago Mercantile Exchange website, updated every day at 1:30 p.m. Eastern Time. COMEX Gold and Silver Stocks report. Most traders ignore it. They are watching price charts. They are following technical indicators. They are reading analyst opinions about where gold is headed next. But there are a handful of people who watch this report every single day. Clearinghouse risk managers, commodity finance attorneys, treasury officials at central banks, and private wealth managers who understand what happens when settlement systems break. Because this report contains one number that matters more than any price chart: eligible inventory divided by open interest, the ratio between physical metal available for delivery and the number of contracts that could demand it. Right now, that ratio is at its lowest level in 15 years, and it is still declining. This is not a prediction. This is not a theory. This is a publicly reported number that anyone can verify. And it is the first indicator that tells us whether the clearinghouse stress becomes a full structural break. Here's how to read it. If the ratio drops below 10%, if there is less than 1 ounce of physical gold available for every 10 ounces of paper claims, the system enters what risk managers call the danger zone. At that point, even a small surge in delivery demand can trigger a cascade. Because clearinghouses operate on confidence. When traders believe they can get delivery if they want it, most of them settle in cash. The system works. But when traders start to doubt that delivery is possible, when they see the inventory numbers declining and the open interest staying high, they change their behavior. They start demanding delivery not because they want the metal, but because they do not trust the system to deliver it later. And once that behavior starts, it feeds on itself. More delivery requests, lower inventory, higher stress, more doubt, more delivery requests. This is exactly what happened in 1980. This is exactly what happened in March 2020 when COMEX had to fly physical gold bars from London to New York on chartered planes because the warehouse system could not handle delivery demand. And the warning signs are already visible. In December 2024, the gold basis spread hit $42. Now that means physical gold was trading $42 higher than the futures price. In a functioning market, that spread should be $2 to $5 at most. And when it reaches $42, it means something is broken in the arbitrage mechanism. Normally, when physical trades at a premium to futures, arbitrageurs step in. They sell physical, buy futures, and capture the spread. This keeps the prices aligned. But in December, that arbitrage failed because the arbitrageurs could not get delivery on the futures contracts. They could buy the paper, but they could not get the metal. And without the ability to deliver, the arbitrage does not work. The prices disconnect. And once prices disconnect, two things happen. First, price discovery breaks down. Futures markets exist to help businesses manage risk and discover fair prices. But when futures prices no longer reflect physical reality, they stop being useful for either purpose. A mining company trying to hedge production cannot rely on futures prices if those prices are disconnected from what physical buyers will actually pay. An electronics manufacturer trying to lock in silver costs cannot use derivatives if the delivery mechanism is unreliable. The tools that businesses depend on for planning and risk management stop working. Second, a two-tier market emerges. There is the paper market where financial traders exchange contracts, and there is the physical market where real metal changes hands. And the two markets trade at different prices. This has already started. In certain Asian markets, physical gold is trading at premiums of $60 to $80 per ounce, above the spot price quoted on Western exchanges. $60 to $80. That is not a shipping cost. That is not a premium for small bars or coins. That is the market pricing and settlement risk. The market saying that paper gold and physical gold are no longer the same asset. Now, here is what this means for business owners and decision makers. There are three scenarios that could unfold from here. Scenario 1, managed resolution. The exchanges implement additional restrictions. They raise margins further. They limit position sizes. They make cash settlement mandatory above certain thresholds. Physical premiums persist, but markets remain functional. The two-tier pricing becomes permanent. Businesses adapt by building relationships with physical suppliers outside the derivative system. This is the best-case scenario, and it requires coordination between regulators, exchanges, and major market participants. Scenario 2, cascading failure. A major clearing member fails to deliver on a large contract position. Force majeure gets declared. Cross-default provisions trigger. Margin calls spread across the commodity complex. Other clearing members get caught in the cascade. Losses get mutualized. Guarantee funds get exhausted. Emergency regulatory intervention follows. Markets close temporarily. When they reopen, the rules have changed. This is the 2008 scenario, and it would impact far more than just gold and silver markets. Scenario 3, controlled transition. Central banks openly acknowledge the shift toward commodity-backed settlement systems. New market infrastructure gets built around physical delivery capacity rather than paper derivatives. Western clearinghouses adapt by reducing leverage and increasing physical backing. Eastern exchanges expand capacity for physical settlement. The transition happens over several years. There is volatility, there are disruptions. But the system evolves rather than breaks. This is the scenario that requires the most international cooperation. And right now, cooperation is in short supply. So what should business leaders do? First, understand the risk. If a company uses commodity derivatives to hedge exposure, it needs to assess what happens if those derivatives cannot settle physically. Are there alternative suppliers? Are there other hedging mechanisms? What is the plan if futures markets become unreliable? Second, monitor the indicators. Watch the COMEX warehouse reports. Watch the basis spreads. Watch for news about clearing member stress or delivery delays. These indicators will give early warning before problems become crises. Third, diversify settlement exposure. Do not depend entirely on one clearinghouse, one exchange, one jurisdiction. Build relationships with suppliers in different regions. Understand the physical supply chains. Know where the actual metal is and who controls it. Fourth, prepare for bifurcation. The world may be splitting into two commodity systems, one centered on Western financial markets and dollar settlement, one centered on Eastern physical markets and alternative settlement mechanisms. Businesses that operate globally need strategies for both systems. And finally, recognize what this moment represents. The coordination between CME and Shanghai on January 14th was not routine risk management. It was an acknowledgement that the commodity settlement infrastructure is under stress it was never designed to handle. And when infrastructure fails, it does not fail gradually. It fails suddenly. The warning signs are there. The data is public. The risk is real. The question is not whether businesses should pay attention. The question is whether they are paying attention before it is too late. Because when clearinghouses start coordinating across borders, when rivals start agreeing on policy, when the system admits through actions that it is stressed, the time to prepare is not later. It is now.